Good afternoon again, class.
Good afternoon, sir.
It's always good to come together, right? This group is so progressive. I enjoy coming to this class, yeah? And of course, you know, we have been doing capital budgeting since our last lesson. And it has been quite interesting. You agree with me, right?
Yes, sir. Yes, sir.
It has been quite interesting, and we've learned a lot, and we now understand that when we're going to actually open a business, there are some factors to consider. Very important, and it's very applicable to life, and that is the great thing about learning. Whenever you can learn something that you can make applicable to your life, you become empowered, right?
Yes.
By becoming empowered, you know what you learn in theory. Okay, you empower someone else. Just to recap and refresh your memory, we have a little video that we want to show to you, about 3 minutes, you know. So we want you to just stay tuned, look back, and get back your memory intact as we proceed to the other aspect of our lesson this week.
This is the first video in our capital investment decisions and the time value of money series. And I'd like to go ahead and remind you that we have the lecture notes that we use in these videos on the website at theaccountingdoctor.com. And we encourage you to go download those, print those out while you're watching these videos, and take notes directly from the video. In this first video, we are going to be talking about capital budgeting and briefly introducing the 4 capital budgeting models. So when we talk about capital budgeting, we're specifically talking about how we budget for the acquisition of our capital assets, so those depreciable assets. There are 4 models that we can use when discussing capital budgeting decisions. And we'll have videos that will discuss each one of these in more detail. But the first one is the payback period. The second one is the accounting rate of return. The third one is called the net present value model. And the fourth is the internal rate of return. The first two, the payback period and the accounting rate of return, are used for short-term business decisions. This is because these two models ignore the time value as money concept, which we'll get into later on as well. The other 2 capital budgeting models, net present value and internal rate of return, they focus on long-term business decisions because they incorporate the time value of money concept. Anytime we're considering a capital budgeting decision or investing in a capital asset, we have to focus on the cash flows of that investment. So we have to think about what cash is that investment going to bring in, or the cash inflows, and what will be the cash outflows because of that investment decision. So let's first talk about the cash inflows that we can see from a capital investment. For example, the future cash revenues that will be generated from that investment. The future savings and ongoing cash operating costs resulting from the investment. So think about a piece of equipment, a new piece of equipment versus an old piece of equipment. So a new piece of equipment will likely require less operating cost than would an old piece of equipment. Also, you have to think about future residual value. So if you plan on a piece of equipment lasting for 10 years, and at the end of that 10 years you could sell it for $5,000 or $10,000, that residual value is the same thing as a cash inflow at that time. And the cash outflows due to a capital investment would be that investment's ongoing cash operating costs, refurbishment, repairs, and maintenance costs that are involved with any capital investment, be it equipment, building, whatever. You also have to consider one of the most obvious cash outflows, the cost of that new investment.
So we've had a little presentation. How was that?
Was very good.
Informative, isn't it?
Yeah.
Very informative, and of course it reminds you of some things that we did the last time. And we understand some of the important points coming out, and of course, the accounting doctor, let me suggest that you can go to that site where future accountants will be teaching your students accounts at the second and the CAPE level. And so it's important for you to get abreast with all these sites and so on and so forth. You have a question there, Alicia?
Yes, sir. One main thing I think is very important is the fact that they say that payback period and accounting rate of return have to do with short-term decisions, right? Those are used to calculate based on short-term decisions. And NPV and internal rate of return have to do with long-term decisions.
Long-term business decision. What do you think they mean by short-term business decision?
Like within a year.
Right.
Within a year or even 2 years or 2 years. No.
And
it's like you don't expect to extend for so far a time, right?
Right.
Of course, you know there are some businesses that you tend to operate for 15, 20, maybe 30 years.
Right.
So you have to consider those techniques.
Right, and internal rate of return.
Very good. And more we go into it, more we learn some formula the last time and so on, so we understand so much about that. But today we'll be focusing on certain techniques that are very important. So it's important that you noted that the class is in agreement with you. That is very important. And entering a project, it's not just an investment project, it's not just a wishy-washy thing.
Right.
It's something that you have to carefully consider when doing so, right? Because of course nobody really has money to waste, even if you might have a whole heap. Because the man who has a lot like Bill Gates doesn't think about wasting $1.
He thinks about it's very important.
Invest in the dollar.
They think it's a profit.
Exactly. What can this dollar bring him? How much more dollar can this dollar bring him? That's correct. So we have to focus very intently on our business proposals that we might have to see how fruitful they will be. So it's a very crucial decision-making process that you have to enter when going into business, right? Now we have, we'll be showing you a PowerPoint while we go along. Just bear with me for a second while I upload that PowerPoint presentation, right? Alright, like, you know, we looked at the video just now, we critiqued it very good. We're now looking at our slide presentation with regards to the topic capital budgeting. I know since last week we were very, very upbeat and up to the time as far as capital budgeting is concerned, so we know that. When this CAPE exam comes, CAPE, what are you going to do with it?
Mash it up.
Mash it up is right. I see you've been doing very well, and your parents must be proud of you, you know, because of course, you know, last time around, you got how many CAPEs you got, Kate?
6.
6.
Yes, sir.
So that Kate is a lot, you know. He wants to be the top accountant in Jamaica, that's what she told me. You know she has the ability, but you know she has to change some little things right around the corner there, right? But you understand that. Alright, capital budgeting, we're going to recap some things as we move into the meat of the matter today. But while we recap, you know, just participate in the program. Dwayne, I know he likes to read for us in class, so Dwayne will probably read this one for us.
Capital budgeting. This is the process in which a business determines whether projects such as building a new plant or investing in a long-term venture are worth pursuing.
That's correct, right? So this process of assessing, analyzing, capital
And
evaluating, yeah, to come up with a decision. The term capital is same, capital budgeting, the term capital in business suggests a long period. Because like you know, you look at the financing your business for a long period of time. Because there's usually what you call the capital market. You remember in economics class, capital market and the money market. Money market is the market for short-term investment goals and so on. But the capital market is the market where you go for long-term goals. You did that in IB, didn't you?
International business.
International business, that's right, and also economics, right? So therefore, capital budgeting, of course, is that process that allows you to examine and scrutinize your potential possibilities, that is. There's another important term I want to write it down as far as capital budgeting is concerned. It's called investment appraisal. You might see that term coming to you. Investment appraisal. Appraising your investment is looking at it, look at the feasibility of it, look at the possibilities of it, and that's what you do as far as capital budgeting is concerned. But let me add some information that are not on the slide, that there are 2 types of project classification. One, we have the independent projects and the mutually exclusive projects, right?
Right.
Remember them?
Yes, sir.
Them.
Yes, sir.
So you should have done some research on it. What you have about, what you gonna tell us about today?
The independent project.
Go ahead.
This is a project whose cash flows are not affected by the accept or reject decision for other projects.
Okay.
Thus, all independent projects which meet the capital budgeting criterion should be accepted.
Right. So therefore, it's not affected by the reject or the accept decision. It's independent of anything else.
Any decision made, it doesn't affect it.
Doesn't impact on anything else, right? So therefore, it can be accepted once it meets the criterion as doing rightly said, right?
Yes, sir.
Right. We have another one. Who knows that one?
Me, sir.
Ketana.
Sir,
What is it?
The mutually exclusive budget.
Right?
And based on what you asked us to research from last class, it said it's a set of projects from which at most one will be accepted.
Okay.
So for example, persons might submit a lot of projects and they might choose one. And all projects that came in is for the same task, but one is chosen which they all agree on exclusively.
Why would they agree on that one?
It may satisfy the capital budgeting criteria more.
Okay. And it means that.
And one may be also beneficial in terms of investment.
Depending on the business.
Depending on the business. And the
Okay.
length of time is a long term.
Right, so it might
Investment.
prove to be more beneficial to the business.
Right.
How do we know if it is going to be? Because remember now, it's not happening yet. Or how would you determine that it is going to be more beneficial to the business?
So we are assessing. So
Assessing.
we are assessing and evaluating.
What do you use to assess and evaluate? It's right there in your heads, I know you know, but I know how it goes. Sometimes here you're thinking like the lawyers, way above the league, right? But you don't need to think so high right now. You know what we use to assess them, Oisha? Those techniques.
Yes,
I know I saw it coming out of your mouth here. You don't know what to call it for you, right? That's how we use
So like the payback period.
But don't go too far, because I don't want to frame because we're going back over them. So since you know so much about them, when I come to it here, I want to ask you about payback period, alright? You just set up yourself. But anyway, I wanted to make note of this to say that there's a thing called cost of capital. What did I say?
Cost of capital.
Cost of capital. Cost of capital. The capital will cost you.
The cost.
Flip it around.
So sir, so is it talking based on like something like to borrow to invest in your business and it
Okay.
comes with a cost like perhaps interest?
Very, very good. Excellent.
Yes.
That's what we're talking about. It comes with an interest.
Interest.
You have to pay to acquire. So that's the additional aspect of your investment proposal, your capital we're talking about, which is a cost. So every investment carries a cost. Every borrowing, every loan carries a cost to it. Of course, you know why cost is associated with a loan. Can you imagine a bank lending you $5 million and not getting any interest? Why do they charge interest though?
For their purpose,
What
to
purpose?
profit, for gain profit.
From this one, I agree. And also too, you remember, just by lending you that money, it causes their workers to work.
Right.
Cause them to write up papers, cause them to print. Exactly. So they can finance very expensive. So sometimes we're going to pay interest on borrow, cost of one borrow, we will pay interest for it too. But of course, you know, interest is very, very important.
Doing content, doing the subject as scheduled.
And expand the business also.
That is true. That is true, Alicia. That's you on the bar. Now, that's what we're talking about, Ketana.
Yes,
Some of the
sir.
techniques in capital budget, and of course we have briefly, discussed them the last time, so you're quite, abreast with what is happening. But these are some of them, and I don't need to go through them item by item, but we run across them. But you see, let me tell you what's happening for today's class. Though we have been through them, though you have been exposed to them, this class now brings in a practical aspect to the topic capital budgeting. So there are some of these that we're going to focus closely on. So we're talking about the criteria and the techniques that we use to identify what projects should be approved and so on. We talk about these techniques. Anybody have an idea of which of these techniques you think is very important?
Payback period.
Yeah, the payback period.
Period.
Right?
And return to sir.
Return on
Average investment you want to know, yes.
And the profit
present value.
Profitability index also.
Profitability index is a very good one. Oisha mentioned a very good one. The profitability index that I actually left off my slide.
Sir, because the last class you had asked us was to look at that one. You gave us them and you said there was one more that you were supposed to
That
give
is
us.
true, Keita.
Yes.
So you're correct. That's why I have to write things down when I come into this class, you know. Because when I don't remember, you're going to challenge me.
Yes,
You know? It's
sir.
very good that you remember, because it will only edify us. So the profitability index is also another one that will focus as far as the calculation of or the calculation for this class is concerned, right? So let's quickly see what we can go through. We look at annuity, of course, you know. But if I skip a minute, you remember annuity comes with what is called a what?
Present value
Present value sheet. So I leave off my present value. Very good. So this is a present value annuity table that of course we can use to pick up what?
The
Discount for any particular what? Year, period.
Yes.
That is right. So annuity, let's see if we can say a little bit more about annuity. That financial product sold by financial institution that is designed to accept and grow funds from an individual and then upon annuitization, they will just stream of payments to the individual at a later point in time. Annuities, I would like to tell you are, based on the years, after a number of years, it is paid out, after a period of time, on certain installments sometimes and so on, right? But annuity, we just need the table as far as annuity is concerned, we need this table to calculate or to come up with our discounts, which of course is important in finding certain answers in an effort to make certain appraisals of certain projects. We will come back to that sheet a little later on when we are ready to practice, right?
Yes, sir.
Now, discounting, as we said, is very important in capital budgeting. Money. Does money remain the same every year?
No.
And when you say no, what do you mean by that? Why would you say no?
Sir, because sometimes it depends.
The way you say something very
Money
important.
loses its value.
Money loses its value.
Right.
So at some point you have to discount the money going down the line so that it can have a true
Reflection.
I don't always use the word true. Somebody say that from true.
Sure.
Yeah, you can have a more accurate value of your assessment of your project. Because of course you can't expect that $1,000 investment will remain the same $1,000 4 years time. So that's why these projects are discounted too. Right? That's why these projects are discounted. So you have to factor in discount so that you can have a better appraisal.
To give it more true reflection.
To give a more accurate reflection of what it will look like in years to come. Right? You know, sometimes you are given a discount to work with, but sometimes as an organization you have to project. Sometimes you look at the rate of inflation in the country and see at what rate money devalues and so on to make your logistics persons come up with an estimation of what the discount might be. And that's what we refer to the annuity table. So if we assume that we're going to have a 5% discount over a 7 years period, then the annuity table can tell us exactly how much a discount to be calculated on our investment will be. You follow me?
Yes,
so the annuity table, I don't know what
so
was...
the discount work with the annuity table.
Definitely. Alright? So that's where we are as far as that is concerned, right? The internal rate of return, okay, we drifted through that one. We've been through it. We of course expect to get returns, right, on our investment, yeah? Our capital budgeting project is of course the discount rate at which the net present value of the project equals 0. So at some point your net present value is going to equal to what? 0. Are you following?
Yes,
sir. At some point, because remember now, we're going to go a little more into it, but just to say swiftly, I don't want to preempt what is coming. But remember that when you invest a certain amount of money, it will bring you money. And you will actually recover that money at a certain point in time. That's where we reach 0, alright?
Yes.
That's the point at which we reach is 0. And it carries a big formula. Good? That's a formula that you have to pay special attention to. Very, very scary. Case says it is scary. But when you get the meaning, remember, I want you to look at the last handout that we gave. So whenever we're ready to practice this one, based on the last handout that we got, we're going to put the figures in, explain it a little bit closer to you, because this formula has to be explained when we're doing a problem with it.
Right.
So we'll understand that. You're going to see that it's not so difficult. Yes.
But I think it was the form that you said for the last class, we don't, perhaps depending on the payback period, we don't need to use all of that formula.
we don't need to use all of them. This doesn't payback we're talking about, and it's probably the same thing for this tool. Because sometimes you see I want to mention this, I want to mention again when we're talking about payback. Sometimes when you're paying back, you pay back on equal installment, or when you get in returns, you get returns on equal installment. And sometimes you get returns haphazardly or they come anyhow. So they're not too equal in terms of installment or you get it. That's when sometimes you're going to need these formulas. When the returns are not the same every year. Alright? Well, you'll see what I'm talking about a little later on. Cool? That's one of Kay's favorite. The payback period. Right, Kay?
Yes, sir.
So briefly, you might want to tell us whatever sentence about that one.
Sir, the payback period represents the amount of time that it takes for a capital budgeting project to recover its initial cost. So therefore, for instance, my idea is that, for instance, if you go to a bank and you go borrow money to fund a specific project,
you're on the right track. Anybody can back her, but she's on the right track.
So,
what's when you get that money?
Because remember earlier on you said there is a cost associated with the capital budgeting.
Alright.
And so when you go to the bank will suppose they lend you 10,000 as a payback for a 5-year period or a 6-month period. So then this is where the bank might use the present value or annuity sheet to help to calculate the payback period. Suppose for instance for over 7 years, interest is calculated at 7% over a 3-year period. So the annuity table will help the bank to identify something like that, sir.
The bank will discount money as well, and they charge the interest to cover the discount as well.
Right.
But you're on the right path in that if you borrow money from the bank to invest, what you want to know is that, and this is key, it's a project that you're talking about, right? You want to know when you're investing, the project will bring you returns.
Get back money.
Will get back
Over
your
the
investment
payback.
over a period of time.
Right.
So over a period of time, remember now that it will equal to what you have invested. What you have borrowed, you would have received it over a period of time. That's like equals to what?
Zero.
And that's talking about our what? Internal what?
Rate of return.
Yes,
Rate of
so
return.
that's where we are as far as the payback is concerned and so, right? Good. Very good, excellent. Now, here is an example question. Here's an example question. Take a look at that example question. Alright, see, write it down. You could write it down. If you want to write it, you could write down that question. Because it might come back to the important. You never can tell. Sometimes you see these little things and you take them so lightly. It's like they come in an examination and you just could have beat yourself.
Yes, sir.
For not having written it down. You know what I mean?
Yes,
I remember seeing it, but you know what? Never write it down. Never practice it. Let me know when you finish writing, alright?
Yes, sir.
Sir, we finish.
We are you.
I am finished.
Okay.
Sir, one more, sir, before you continue. One more.
Finish. Go ahead. Let me see.
Kay always slow because she talked too much.
You don't see, originally you don't see that you leave off the net cash flow for the 4th year.
See, sir, you see, but you still finish.
You leave off the net cash flow for the 4th year. Original. Careful, always check your work, right? But 6 for me and then the first one again original. Yeah.
CMT, yeah, talk before you're right.
But I used to have the wrong thing a while ago. Sir, finish, sir.
Alright, so we have it, right?
Yes, sir.
What you notice about the, what was the initial investment? What was the initial investment?
1,000?
$1,000, right? Good. How many years?
5 years.
5 years. Now, it means that there's a negative balance because that has been invested, right?
Right.
Your expense, right?
Yes.
Now, in the first year, how much did the project return?
500.
500. Very well. I see you on the board. The project returned 500 in the first year. And the second year, but notice, when it returned 500, it now means that the amount of balance outstanding is what? 500. So that makes it right there, right?
Oh, because I was going to answer why we have a negative 500.
Okay, and this is the practical aspect which we'll go more into for today's class. So you see why we have it, right?
Yes, sir.
So this project is still outstanding on returns of 500, right?
Yes.
Good, and then we see there's a return after that in the second year of
400.
Now this project is still outstanding on what?
100.
100. Now in the third year, how much this project brought in?
$100.
Now it brought in how much?
200.
200.
100. Therefore we're now what?
On par.
We're now what? Over the initial investment by how much?
100.
Because the initial investment was how much?
1,000.
1,000. And for all these years, it has returned how much now?
900.
1100 is right. 1100 is right. So it has no return in the third year. But look at it closely. And you're actually solving the problem already without using the formula of payback. So you see that the initial investment is already paid back by the time we reach the what?
Third year.
It's even before the third year ends, not true?
Yes, sir.
We don't even need 200 to pay back the initial. We really needed how much? 100. So if 200 is for 1 year, the third year, 100 is for how long?
100.
About
If 200 is for 1 full year, that's the third year, 1
Half year.
So really, this company needed what? 1, 2, and a what? Half year to do what? Pay back for its investment. You see? We didn't formula yet. Exactly.
Yes,
So you
sir.
have a project and you're investing in that project. When you calculate your payback, you will see that this project will bring you back your investment in 5 years. This project will bring you back your investment in 7 years. This project will bring you back your investment in 9 years. Which project will you choose? But they will not all be constant with the same factors. In fact, you'll understand that this is not really what we will use to assess the viability and the profitability of your projected project. Though it is important we can understand it, right?
Yes, sir.
All things being equal, then we can understand that we want our project to return funds as soon as possible. no?
as soon as
Very
possible.
well. That's not the only factor involved in capital budgeting. In fact, that's not even the most important technique in assessing your capital budgeting situation. We will get to it.
Yes,
We will get to it. Alright, so that's where we are as far as an example question. Now we have a question that we're going to practice in this class on the board, and also we will give you one as your group to practice and report to the board to see exactly what you have done. I have a question. Was there a...
No, sir, it's alright. I was just explaining something to her. She didn't understand.
Okay, I thought you had a question right there. But observe now the payback period on the board. The payback period formula, right?
Yes.
Notice, this is the formula. I'll explain that in a second. This formula looks at the last year with the negative figure?
Oh, so before we were at the negative 1,000.
Watch it. What year was the last year with a negative figure?
The second year.
The second year was the last year with a negative figure. Do you follow me?
Yes,
So the
sir.
second year will be the 2, right?
Yes.
Alright, cool. That's why you'll put 2 right here, no?
Yes, sir.
Good. Plus the absolute value of
Yes.
The negative figure.
in that year. The absolute, no, not negative figure, K. The absolute value of net cash flow in that year. Which year was it again?
Second year.
What was the value of the cash flow in the second year? 100. Ignore the negative, right? 100. So therefore, what will this be? 2 plus
100.
over total cash flow in the what?
Following year.
What's this?
Total cash flow is 2.
What's the cash flow in the following year? 200. So let's look at it now. So this will be 2 plus 100 divided by 200, and that will give you a payback period. We're not working it out now because we're going to go to a real question. But I'm showing you see how brilliant you are as a class?
Yes, sir.
You actually have the problem work out like that. No, but we will not write it now because we have a question that we will practice it, alright? So therefore, you understand
But
that.
sir,
Remind you.
sir, so that means the last year you would the two right over
We're
So that's here you have the one.
100 would be.
The 2.
Yes.
What you have here?
100.
Over what?
200.
Oh, it was 2. Yeah, 200.
You follow me?
Yes, sir.
Obisha, do you know what this will equal to?
Yeah, hold on.
You're the calculator, girl. You don't need your
So
calculator.
which part you would have in your refer to?
6 formers. You've been past this GMAT mathematics, right?
So 1.2, 1.02.
So this gives you how much? 0.5. Right? This is half of that. 2. So therefore it will be 2 plus
No,
0.5.
sir, it's 2.5.
So it will be 2 plus 0.5. That will equal to 2.5. What's the meaning of 2 and a
2.5
half?
years.
So you see the payback from the 2 and a half years
So
that we
it
got.
will take 2.5 years to pay back.
Payback, we look at it.
Yes,
See how it fits in.
Yes,
See your
sir.
capital budget in this
Yes,
that makes
sir.
sense?
Yes,
I
sir.
know you're on top of this game, man. And you make classes so easy, I'm telling you. You students, this school, I want people to call the name of the school. But sometimes when I call the name of the school, I boast too much, right?
Yes, sir.
I tell you, right? So, look at that. What's that?
Oh, that's what we just did, sir.
We solved it before you even see it. Before you even see the solution, right?
Yes,
So,
sir.
this class, remember the motto? Don't depend on anyone else. Okay?
Use your own thinking.
Exactly. But it was your own ability.
Abilities.
Right. Don't depend on anyone else, use your own
Ability.
Alright, and you have been doing that very good. That's why you're in upper 6, right? That's why Kay got good grades in her in lower 6, you know?
I'm
Kay
introducing.
did well, right? No, I know Dwayne did well as well, I know Isha.
Yes, sir.
Shimon, I didn't get your results, but because you're not from this school, you're just coming to all 6 form, so we understand, but we didn't want to be too inquisitive and people are sometimes.
Sir, just have to pin them business.
I never said what subject you did, I never said what grade you got.
Okay, sir.
So I'm not talking any business, I'm just talking the truth of the matter. Alright. Net present value Ketan. You see that one?
Yes,
Where
sir.
is talk to us about Ketan?
The net present value of a capital budgeting project indicates the expected impact of the project on the value of the firm.
The expected impact of the project.
Or it will impact the firm,
How
or the project will impact the firm.
So, sir, like for example, like projects with a positive net present value, sir, will increase the value of the firm.
Exactly.
Yes,
It
sir.
does.
Value in terms of what? The value in terms of
Yeah, I mean, income makes a company valuable, as you know. Income impact. Why do you think some companies are powerful companies? You think a company doesn't just get its name because it's a good
Sir, see,
but
that's
its
so-
earning makes it powerful because its
Physical
earning gives it the ability to maneuver and to put itself in certain position and so on.
Sir, so for instance then, like for example, Supreme Ventures. Every time you realize they come in with a new project, cash flow now them have done it to us.
Yeah, like every
So
million
they have to analyze. So in reality, I'm just trying to link them towards what we are doing. So they have to, that means they come up with another project, they see which one they will get back their return and stuff like that.
Sure, and of course it impacts on them.
Which one generate. So they realize that the P2 will work, so they go with it and.
Of course they do their assessment and so on. And of course,
So if you see that impact the business, it will make the business make a profit.
so, you know, we saw where the net present value is very important, Kitana.
Yes, sir.
As you identify the value of a project, when you appraise it, you looked at the Supreme Ventures and how they are the big two.
Yes, sir.
And that it was very, very profitable for them, right? And that's why the cash pot. And if I ask you, what is cow in cash pot? Cow. 9.
You buy gas?
9. What is 14?
Mouth.
Mouth, get on the chat to us, right? Alright, but of course they would have appraised there, but you're nice to pick on, Ketana, like a nice pretty right mom, you know what I mean? Yeah, but anyway, they would have appraised their project, you know, and they know what works and so on, right?
Yes.
But let's pick it up from return on investment, right? Oh, we show you mind reading that one first, please?
Alright. Return on investment. This is a performance measure used to evaluate the efficiency of an investment or to compare the efficiency of a number of different investments. To calculate rate on investment, the benefit of an investment is divided by the cost of the investment. The result is expressed as a percentage or a ratio.
Right. So you see the formula basically will be the gain from the investment. You could write this one down if you don't have it on. It's not being protected there on the board. Oh, it's right there. Sorry, right back. So it's right there. Make sure you have that one. If it's not on your handout as you had a couple hours, be sure to write that one down. Right? See what it is? The gain from the investment minus the cost of the investment
Divided by the cost of
investment.
You will see this one in action a little later on, right?
Yes, sir.
And that is called the rate on return on investment.
So the gain from the investment is basically what you get from selling some, from selling
cash that the investment brings in.
Oh, like a profit, like a profit.
Also cost to invest. Remember earlier when we were talking about the cost of the capital.
Right? And the capital will bring you cash.
Yeah.
And how often it brings you cash and how much cash it brings you, how rapidly it covers its investment and so on. So that's your return. How much you get back on the investment. Your sales, your profit, right? Obisha?
Yes, sir.
Alright, good. Let me tell you this though, that the above formula, that formula right there, right, gains for investment refers to the proceeds, as you asked, the proceeds obtained from selling investment or the interest of it, right? Very important to know. Return on investment is very popular. It's a very popular metric because it is versatile and it is simple. Because it can clearly show you how impacting your investment has been based on your returns that you are getting. So you compare your return to your investment and you see how well you are doing. You don't need so well, of course, you know, you're not going to undertake that project, right? So I know many of us probably thinking about selling back juice, Ketana. Why do you think of that?
Me alone in the class.
I'm sorry.
To pick on.
Dwayne, why do you think so many people back juice business go out of business?
Because it not give them a gain or it's not fast enough or
right,
something.
returns is not so great.
Right.
Exactly. And of course, you know, it's not
Also, these
motivating.
the people sell back to sell it afterwards, them have one beat, one can.
No, son, of the bad juice give them that.
Maybe they...
Even sometimes I always wonder, you ever been downtown and see the seller selling too sweet here?
Yeah,
you wonder why they might do it, how much them can get per day after these selling.
But
So
they
you
get
ever
in
think
the
about it?
No, they get because sometimes you see them move up to one little start, you see them start to one little start. But we might be surprised, that's what so I was telling you, remember, like, oh, them, like what you said, Bill Gates take $1 seriously. So maybe if you never come to the meeting, I go see them take it seriously and invest it wisely.
I remember the Jamaican cliche, every maker
Make a mark.
No, me not think
I
about
remember-
them patient.
well, that
That's
is
a
different.
you.
That is different. But you see, sometimes you can only invest what you have. And so you are thinking about a big investment like a hotel chain or maybe a big
Right.
house and the
But
man
those
on the
who
road.
think can bring you
What?
some
Bring you some
investment.
Everything are what they
Start
have.
from small,
And can
start
bring them
from
small.
somewhere.
Right? That's right. And sometimes it was like a small profit, squeeze it up so nice, and sell them so quick sales,
True enough,
small
sir.
profit,
It's
because
sell quick.
sale quick.
Them sell it to the back of the man, they go put the back.
Sir, that is true now because I remember I had this man in St. Thomas, Marby, named Clive. You know Clive, in Marby, Clive business name?
Sure,
But,
yeah.
my grandmother told me that he started off selling pants length and card. And right now he's one of the most successful businessmen in
And you know what, the way pants
in
length-
Marby. He have a liquor store, he have two.
One relative from the 91.
Yeah. So that is true, you know, so I can
So you see the bigger profit, so we might not say I mean none about them invest.
Yeah, and he follows that business according to the stage and the standard of the business. He's not going to compare that with pants length business with D&G. But when you hear D&G makes millions of dollars profit, he's not worrying about that. He's worrying about his return and that his little business
But-
is profitable and he gives it good appraisal and see where it puts him.
But sir, you know, sometimes we might help on them big business and I say them I make profit and them nah make no
No,
profit.
but not true.
Because when you look at JETC and them place, they don't make no profit.
Maybe he's
They're
not
more
making any
loss.
profit, but
Them
the overheads.
Right,
The overheads might be too high. And so those overheads cost so much.
Yeah,
Yeah?
sometimes might look at them little business and not make no profit, but they do make more profit than
Yeah,
a big business because they don't really have no
They have less stress, right?
Yeah, no life.
I tell you. Alright, there's another one I want to mention to you that is not on the slide. It's called the Profitability Index. A very, very
One that
important
you
one.
have to research.
The one that we have to research.
Yes,
I know you must have done your research on it. And it's going to be important in
But you
today's
have,
class as
yeah.
you do a calculation. Right? So who wants to tell me what they have now?
We said an index that attempts to identify the relationship between the cost and benefits of a proposed project through the use of ratio calculated as PV of future cash flows over or divided by initial investment.
Okay. So that formula will give us a ratio, right?
Present value.
PV is present value.
Yes.
Anything else you want to add to that, Ketan?
Sir, when I researched it, I said the ratio of 1 is logically the lowest acceptable measure on the index.
Okay.
Any value lower than 1
Right.
would indicate that the project's PV is less than
Present
the
value.
initial
Present value.
investment.
Okay. So the present value, the value of the company at this time is less than the initial investment. How much invested? You don't want a project that will yield a value of less than what you put in. You know, I remember too, you know, and that's why sometimes when you read a little further, you find the critique comes in that this thing can't be solely based on cash. The assessment cannot be solely and entirely based on the value of the cash that was invested. Because what about all this whole heap of work where you put in? Your plans and your proposal, you set up late night sometimes, the labor you put in. All these are not calculated in it either, you know.
True.
And all of this effort for what?
It contribute to the success of the business.
Good. All of this effort will contribute, but at the same time, this business now has a PI, a profitability index of less than 1. It means that this business value is less than the initial investment. After so much work, so it's important to assess. It's like one of my friends was going to have a fish fry. And after them done work it out and work it out and realize, I said, boy, I might end up with a profit of 5,000. So he said, boy, well, at least I make a profit when I'm done. I said, man, when you're done making a profit, you're going to be so tired, the foot might hurt, you have got a doctor and give 4,000 out of the 5,000 for the doctor. And the other 1,000 you are buying medication. And you're going to tell the amount of effort that you put out in this project. Maybe 5,000 is not even worth it. No, it is a profit.
No, it is a profit.
No, it is a profit.
It's not.
And that's why you're going to find out later on that even though the organization is profitable or is making a profit, it doesn't necessarily mean that it is profitable.
Right.
And there are other factors involved, right?
Yes,
That's why
sir.
capital budgeting helps you to assess
Before you
properly
invest. Before you
to make
invest.
decisions before you invest. There's a little advertisement on the television. I was very good to
So I
say.
remember this advertisement from the Financial Services Commission
Right.
when they said take up all our sheets, save and go invest in
In
our
our
new
business,
business.
yes.
Yeah.
And the business place no register with FAS and them gone with the money.
So when you look for a business place,
And now we know there's a bush up place. But then somebody else come back and tell her she still wants to go try and say, remember when I'm here the last time.
So you must think
Before you invest.
Exactly. I had a bitter experience with cash plus too.
Yes, sir. Pyramid.
You see, I was looking at the payback, and the payback was excellent. I was thinking, man, in 10 months you have back your initial investment and you keep on getting on and on and on and on.
So sometimes
People have been getting, but I was too late.
So sometimes, sir, I don't think sometimes that's greed. Because, sir, if I invest in something, you know, I'll invest and I make back what I get. I drop back some of the money, I make it safe because I know it is a pyramid, it can crash at any
It's true,
time.
and that's
Sometimes it's greed.
That's logical thinking. Remember, that's what happened with the Sanford. That's what happened with the Sanford situation. You know, Sanford 2020 cricket.
Yeah.
Sanford is now behind ball because he was running a scheme and so on, and he gave the cricketers $1 million for the 2020 games. Some of those cricketers invested back the money with him, with Sanford. But other cricketers like Chris Gayle and some others now,
Smart.
for them $1 million US.
Yeah, I would.
Right?
Sometimes it's greed.
And then for them, their million went down with Sanford. So sometimes you have to think before you invest. But appraisal is very important, and we cannot overemphasize the point of appraisal. And of course, profitability index, measuring the returns of your project is very, very important as to what it will yield at a certain time. Where will it be in comparison to your investment, right? So we have been through many details as far as this is concerned. We're going to look at now working a problem as far as this is concerned, to look at the profitability of the organization and should the project be accepted or not. But before we do that, we're going to sit again and recap our mind, look back, refresh our mind, relax a little bit, get in the frame of mind to start practicing the question by looking at this particular video, okay? So we're going to look at this video in preparation for the practice.
Alright.
So let's focus on this video.
To our second part.
To recap, refresh our mind.
Which is
What?
value
Pay attention.
of business.
That would have been an omission.
Before this video, you should first understand the concepts of present value, net present value, basic capital budgeting, and the weighted average cost of capital, or the WACC. Now, if you don't understand these concepts yet, then I recommend that you first watch the other 3 videos on these topics above. Alright, let's get down to it. Now, when we say valuing a business, we're actually trying to answer the question, how much is a business worth? So if you remember, here is a store, here is a business, an existing business. How much is this example? Maybe you want to buy this store from this owner dude guy over here. You want to buy it from him. But before you buy it from him, you have to find out how much is the business worth. Okay? And here is where financial managers and accountants have different philosophies. Okay? Because most accountants, the way they would value a business is they look at the price of the assets, the shelves, the building, the uniform, and then they look at the price of the liabilities or the debt. Maybe they owe money to the bank, and then they subtract the debt from the assets, and they come out with something called owner's equity. And that's how accountants value the business. The amount of owner's equity is how much the business is worth. Okay? However, if you don't understand that, by the way, don't worry. However, financial managers, we don't care about the asset value
and the owner's equity. We don't care if this shelf costs $1 million or whatever. We don't care if the business building is worth a lot. Usually, okay? Usually. What we do care about is the net present value, or the present value of the free cash flows. Okay? So this is another way of saying how much the store actually earns. So if a store has, for example, $10,000 worth of shelves and equipment, but it earns only $5 a year, for example, then the store is not worth much. Because even if the assets are worth a lot, the fact that it earns such a small amount means that it is a bad business and it is worth little. Okay? So most financial managers put a heavier importance on the earnings of the business rather than, or instead of, the assets of the business. Okay? And these earnings, one way of representing these earnings is by looking at the free cash flow. Okay? So the way we value a business is we look at the present value of the free cash flow plus the present value of its horizon value. Okay? Now, don't worry if you don't understand these terms yet. You will see in a while. And one more thing, how to compute the free cash flow, I will discuss that in another video. So for this video, I will just give you the amounts or the figures of this business's free cash flow so that you can understand the concept quickly. Alright, let's move on. So for example, this business, this store, which we saw over here, has free cash flow earnings of $10,000 in year 1, $12,000 in year 2, $11,000 in year 3, and $13,000 in year 4. Okay? And this is given. Okay? In more advanced problems, you would have to compute this yourself. But I will do that, discuss that in another video. So let's just assume and pretend that these are the free cash flows of the business, of the store. And then I give you the following given information. Okay, the first thing is horizon year is year 3. Okay? Horizon year is year 3, which means this. Okay? Now, it is very important to remember. Now, you might be wondering, what the heck is a horizon year? Well, horizon just means that you look into the future, right? However, most people make the mistake of thinking that the horizon year is the last year of information that you are given in the problem. Okay? Do not do that. Year 4 is not the horizon year. Okay? Usually, your professor will say the horizon year is 1 year before the last year, or year 3. Alright? So, remember to always read the problem carefully and look what your professor says is the horizon year. And in our case, it is year 3. Alright? Now, if you're wondering why we need to know this horizon year, you will see in a short time later, a short while. I'll show you why it is important. And we know that the weighted average cost of capital is 10%. Okay, that is given, is 10%. average cost of capital, WACC, by yourself. And if you don't know how to compute this, you can watch my other video about WACC. Alright, and the other piece of information which is given is that the estimated free cash flow long-term average growth after the horizon year. So this is the horizon year. And after the horizon year, we have an estimated long-term average growth of 5% per year. So this year 4, year 5, year 6, year 7.
So there we have the video, and I'm sure that you must have learned something new or would have revisited some principles in your head, right?
Yes, sir.
So we're quite upbeat, and we have a little more understanding as to what's happening with capital budgeting now, right?
Yes, sir.
And so we expect you to start making decisions, start appraising projects, right?
Yes, sir.
So now we're going to calculate the payback period of each investment project, right? There are 2 groups right there. I'll be doing the example and you'll be following me. Of course I know you know how to do this. So let's do the example now. Get on of the payback period. We're ready. The group is 400 close together, that's fine. Good. Alright. So now, we're thinking about Project A. Project A. What we trying to find again? What we're trying to find the
Payback period.
payback period for each product, right? For each project, sorry. Good. What's the formula for finding the payback?
In this case, initial payment over cash flow.
Initial
Payments
divided by
payments
cash inflow.
over
cash inflow. And we use this formula because cash flow is
your group Owisha will do project 1. B therefore means that case group will do what?
C.
Okay, doesn't take a rocket scientist to figure that one out, right? So then, payback. What's the formula?
initial payment over cash inflow.
Initial payment divided by the
Cash inflow.
cash inflow.
And we use it when the cash flow is constant.
Constant. The simple formula, right? Therefore, payback is equal
212,000.
the initial payment 212,000
508
508
over
over $90,000, right?
Yes,
So
sir.
the payback period will be
2.361.
2.3612.
2.5.
2 point what? 5 or 4?
4.
Okay, now this is 3. So if you were to add 1 to 3, what will that be?
4.
What do you get again for C-sec, man?
So I don't like, man.
Now what this means again in terms of
2 years.
right, we can round it up, right? So
2.4.
this will really mean 2.1.
4.
That means
2 years.
2 years
Four months.
4 months for what?
Get
To
back-
pay.
to pay
To
back
repay.
it.
Initial
The investment.
investment.
Yeah.
You follow this now?
Yes, sir.
So this is how we calculate. You will see what the other investment projects will use in terms of payback period, right? So the groups will now sit and work out the other 2 payback periods, and then when you're through, you're going to come and record what the group has done on the board, okay?
Yes,
So
sir.
we do that now.
Sir, we are doing what again, sir?
C.
27. Yeah, and the cash inflow 60,000. So how much that again? 2,7,448 divided by 60. 3.79.
The low man.
We're gonna roll it up.
Oh, we said, reading on the mind, and we have people at work.
3 years. 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 3 ye
Oh, we're finished? Okay.
Group B.
And what's your group here?
Although we are 8 class. We like to see this thing.
Come now, Dwayne, we're going to do project B. What about the A to B? Just do project A.
Change the A to B.
So our initial payment is 227,448. No, 227.
No, 227.
227. Divided by 60,000. Give us 3.7908. So I'm going to roll it up now. 3.8. Which means
3 years
and 8 months. That's the time we're going to take to get back the initial investment.
Okay. Alright, that's good doing. That's good group B. Alright, so we're going to invite the next group to come and present their finding of the payback period for project C.
Search like in the board, alright.
It's your choice, Kitan. It's okay. I think we have recorded it, so you can. Did you record it?
Yes, sir, alright. Yes, now we are doing project C. I do have to write them. Okay, since the formula is already up there, payback
Equal project C 270 and 80 and 50,000.
4 year and
Equal in the same line.
4 year too.
and it is figures rounded off. To 4.3, which means 4 years and 3 months to complete the initial project. Complete the initial project. Initial investment for project C. Correct, sir?
Is that correct, class?
Yes, sir.
Class is in charge. They say you're correct. Thank you very much, Group C.
There are 8 people.
Right?
Yes, sir.
How did you find out?
Easy, sir.
Easy. You're good learners, Ketan, right?
Yes, sir.
What should we be calculating now?
The net present value for each
Net
investment.
present value for each investment. Now, I'll be showing you this one. First example of this, and the group again will do their group work, their collaborative effort. And your collaborative efforts have been good just now. Keep it up. And I guarantee your success in future examination, right?
Yes,
now,
sir.
with this present value, we're going to present a table. We're going to present you with a table, right? So we're looking at the net one.
Present value. So that's what, sir, we're going to get break.
Yeah, we're going to get a break, Ketana. Don't worry about it. We're getting a break for you. I know we've been going long, it's been hard, and so you had a hard day, but don't worry about it, right? Now, when we look at, for this one, we're going to assume Robert Matthew, remember we were talking about what?
Discount.
And also we were talking about the what?
Annuity table.
The annuity table, remember?
The present
Present value
value.
annuity table.
Yes, sir.
We're going to go back to it. What percentage discount would you want to assume in this case?
About 10%.
Let's assume a 10% discount. And we're going to refer to the annuity table and see what it comes up with, right? Now we're going to be having a table. We're going to create a little table for this one. Pay special attention to it, alright? This is the year. This is the cash flow. We're going to consider the discount factor in this and the present value. Now we're observing this. The year, in the initial year, the investment for project A, right? This is project A.
Yes, sir.
What's the initial?
$212,508.
508. And now there's no discount factor in the first year because the money is as pure as it can be, okay? No discount factor in the first year. So in the initial investment, so the value of the initial investment will remain the same. But when it comes to how many years are involved in this?
3.
So 1 to 3. See, because they are the constant, because the returns is constant.
Oh, you don't need to work out.
You don't need that big formula, remember? Each year will give you the same. So 1 to 3 years, and the return for each year is what? 90,000. Now we will go to the annuity table to find the discount factor. Let me find back the annuity table for you, so we can arrive at the discount factor involved. Yeah, this was Alright, there we have it. Take a look at the annuity table now. And the discount factor. We're talking about how many years now?
3.
3 years at 10%, right?
Right.
Let's see where that will land us. So here we have the 3 years.
Yes, sir.
3 years right there, come across
10%.
for 10%, which is right here.
2.46.
2.4869. You see that?
Yes,
That's what the discount factor yields. So let's plug that in as the discount factor now. What is it again?
2.48.
2.4869.